Welcome to the Deep Dive, your shortcut to being well-informed. We take a stack of sources, pull out the crucial bits, and, well, add just enough banter to keep things interesting. Today, we're plunging headfirst into the fascinating, sometimes, let's face it, perilous world of investing. And to really kick things off, let's start with a story that still, I think, gives Wall Street the chills. The incredible rise and, well, the utterly catastrophic collapse of long-term capital management. LTCM.
Oh, absolutely. It's a legendary story, really,
Yeah.
and it's a critical lesson. You got to picture it. Late 1990s, this hedge fund run by, literally some of those brilliant minds out there, Nobel Prize winners even. We're talking Myron Scholes, Robert Burton, are the guys who basically wrote the book on option pricing theory. These weren't just smart people. They were seen as the smartest, armed with these incredibly complex derivatives-based strategies.
And leverage to the hilt, right? Something like 25 to 1 on borrowed money. 25 times. Which, sounds insane now. And for 4 years, it seemed to work perfectly. Quadrupled investor money. Everyone thought, okay, they've cracked it. This is the secret formula.
Exactly. But then, as our source material for today, William Bernstein's The Four Pillars of Investing, lays out so vividly, it just imploded spectacularly fast. It's like a financial Icarus story, proving that even absolute geniuses armed with Nobel-winning ideas and staggering leverage are absolutely not immune to just, spectacular failure.
Yeah, and that story right from the get-go, it just perfectly highlights the central tension in investing, doesn't it? That magnetic pull of high returns, it's always tethered to the very real risk of, as Bernstein calls them, bone-crushing losses.
Precisely. The LTCM saga isn't just some old Wall Street story. It's this profound warning about what Bernstein labels dumb stuff in investing. Things like overreach, hubris, definitely excessive leverage, and maybe a fundamental misunderstanding of your own true risk tolerance. It's a powerful example of that illusion of control, especially when you're playing with borrowed money and, these intricate financial instruments that maybe even the creators don't fully grasp in all conditions.
And what a contrast that story makes with another incredible narrative we're digging into, Sylvia Bloom. Just imagine this. A secretary in New York City, works for 67 years, and through nothing more glamorous than just simple, frugal habits and the sheer, almost relentless power of compound interest, she ends up amassing a multi-million-dollar estate.
It's amazing.
She wasn't chasing hot stocks, wasn't trying to time bubbles, no complex derivatives. She was just, plain and simple, getting rich slow, which it turns out is a much, much safer bet.
Her story is really something, almost the anti-LTCM, like you said. Bernstein shares this great little anecdote. She's 84 years old. It's right after 9/11. And despite having millions, she walks across the Brooklyn Bridge and takes the bus home. That frugality, it wasn't about being cheap. It was just part of who she was, a deliberate choice. She never got caught on that, hedonic treadmill where you just keep needing more and more stuff. She just understood that time, patience, letting her money work for her decade after decade.
Yeah.
That was the real strategy.
That's such a powerful setup, isn't it? These two stories side by side, the genius flame out and the quiet triumph of patience. It perfectly frames what we're doing here today. We're diving deep into the core lessons from Bernstein's Four Pillars. Our mission really is to equip you, our listener, with the essential theories, the history lessons, the psychological insights, and the business realities that actually determine investment success. We want to arm you with the knowledge to avoid all that dumb stuff that can completely derail your financial journey. Basically turn all this complex information into clear, actionable ideas for building a portfolio that works for you.
Think of these four pillars like the legs on your investment chair. It's Bernstein's analogy, and it's perfect. Neglect even one leg and that chair. It's going to wobble, and eventually it's just going to collapse. So we'll explore investment theory, investment history, investment psychology, and the business of investment. And we'll keep connecting it all back to your financial goals and how you can navigate what Bernstein calls the highway of riches.
Okay, let's start with Pillar 1. Investment theory, the unbreakable link of risk and return. This is like the absolute bedrock, the fundamental truth. If you only take one single idea away from this entire conversation, honestly, it should probably be this. Risk and return are just, they're inextricably linked. You cannot escape it.
Absolutely.
You can't reasonably expect high returns without, at some point, facing those gut-wrenching, bone-crushing losses he talks about.
And the flip side is just as true, isn't it? Safety, real safety, inherently comes with lower returns. It's not just a theory. It's how markets fundamentally work. We saw it so clearly during the dot-com bubble in the late 90s. Stocks soaring 900% one year could just as easily, and often did, plummet 90% the next.
Crazy numbers.
Yeah, and the real takeaway isn't just the math. It's the psychological challenge, right? High returns demand that you endure those losses. And frankly, most people just aren't wired for that kind of emotional roller coaster. So it forces you to ask yourself, when you picture your financial future, are you truly honestly prepared for the downside that inevitably comes with chasing that upside?
To really hammer this home, let's look at that thought experiment Bernstein uses, Uncle Fred's coin toss. Imagine you've got two choices for your retirement savings. Option 1, a super safe 3% perpetual bond, rock solid. Over 35 years, that grows to $302,310. Sounds okay, right?
Seems decent.
But here's the catch. If inflation averages, say, 3% over that same time, which is historically plausible your real spending power, what that money actually buys, it's only $107,436.
Right.
Suddenly not quite as appealing.
Definitely puts it in perspective. Now, option 2. Your slightly eccentric Uncle Fred offers a coin toss deal for your money. Heads, you gain a massive 30% for the year. Tails, you lose a painful 10%. Your gut probably screams, no way. That 10% loss feels really scary, especially if you imagine a string of tails.
Right. And conversely, if you somehow got all heads, Fred would owe you like $162 million, which is, wildly improbable.
Vanishingly small chance. But here's where the insight lies. If you get a more realistic alternating pattern, heads then tails, heads then tails, over a long time. So 1 year up 30%, the next down 10%, then up 30% again. Your return in each 2-year cycle is 1.3 times 0.9, which equals 1.17. That translates to an 8.17% annualized return. Suddenly, that looks a whole lot better than the safe 3% bond, doesn't it? That's an expected risk premium of over 5%.
Wow, okay. So the volatility, even with the losses, pays off over time in that scenario.
Exactly. And this brings us to a really crucial but often misunderstood concept, the difference between geometric and arithmetic returns and this thing called variance drag. See, most people instinctively just average the plus 30%, negative 10% to get 10%. That's the arithmetic return, the simple average.
Right, makes sense.
But the book makes it clear the annualized return, the actual compound growth rate, the number that determines how much money you really have, that's the geometric return. And we just saw that was 8.17%.
But lower than the simple average.
Always lower when there's volatility. That difference, that's the variance drag. It's like this hidden penalty, this tax that volatility quietly levies on your actual wealth. It slowly chips away at your gains, even if the average return looks good on paper. A bumpy 10% average is not the same as a smooth 10% annual gain.
That's a really important distinction. And then there's the order of returns. If no money is going in or out, the order doesn't matter for the final number, right?
Yeah.
But it matters hugely otherwise.
Massively.
Yeah.
This is the whole concept of sequence of returns risk, and it affects savers and retirees completely differently. If you're young, saving regularly, you actually benefit from bad returns early on, followed by good returns later. Why? Because those later high returns get to compound on a much larger pile of cash you've accumulated.
Okay. So low prices early on let you buy more shares.
Precisely. But for someone in retirement, drawing money out, it's the complete opposite. You desperately need good returns right at the start. A nasty sequence of losses early in retirement, especially when you're selling assets to live on, can just decimate your nest egg. It can put you in a hole you might never recover from.
So this really forces you, the listener, to think, am I in the accumulation phase, saving up, or am I in decumulation, spending down? Because your stage in life fundamentally changes how you should think about risk and design your portfolio.
Absolutely fundamental.
Okay, so if risk and return are joined at the hip, where do they actually come from? Let's switch hats for a second, from investor to, say, a business owner looking for funding. If a company needs money to grow, they basically have two main options, debt or equity.
Right.
If they take out a loan that's debt, the business carries most of the risk. If things go south and they can't pay it back, they could go bankrupt. The lender, who you can think of as the bond owner, has a relatively lower risk. They get paid first if things go wrong.
Makes sense. But with equity, the company sells ownership shares. Now the risk flips. The equity owner, the shareholder, takes on more risk. They could lose their entire investment if the company fails. But for the business itself, it's lower risk because there's no legal requirement to pay back that capital or even pay dividends.
Okay, so the shareholder takes more risk.
And demands higher potential returns for doing so. That's the equity risk premium. It's the extra return stock owners expect and have historically received to compensate them for taking on that greater risk compared to bondholders. It's the market basically saying more potential reward means you accept more potential pain.
And how does this connect to personal finance? Like the classic dilemma, pay off the mortgage or invest the cash.
Ah, yes. The book makes a really strong point here. Using your mortgage like a margin loan, meaning instead of paying it down, you invest that cash in stocks, is often a bad idea.
Why is that?
Well, first, your mortgage interest rate is usually higher than what you'd get on safe bonds. Second, you're essentially leveraging your personal balance sheet, adding significant risk. It's like taking out a loan you can't easily get rid of, increasing your overall financial vulnerability.
So the takeaway is,
Pay off that mortgage if you comfortably can. When the inevitable market storms hit, trust me, you will sleep a whole lot better knowing your house is secure. It reduces your overall financial fragility.
good advice. Okay, moving beyond theory now. How do we actually estimate stock returns in the messy, real world?
Well, first, it's crucial to shift your thinking. The true value isn't just the number jumping around on your brokerage statement. It's a potential stream of income. Those assets can generate interest from bonds, dividends from stocks. The British, Bernstein notes, often had a better handle on this, thinking about wealth in terms of annual income generated. Americans tend to fall in love with a statement number, which can be misleading.
So how do we estimate that income stream for stocks?
The book offers a simplified version of the Gordon equation. Basically, the expected return for stocks is roughly the dividend yield you expect next year, that's dividends per share divided by the price per share, or D1P, plus the expected growth rate of those dividends over time, G. So D1P plus G.
Okay, dividend yield plus dividend growth. Seems straightforward enough.
It's a good starting point for the fundamental return. But, and this is big, but we absolutely have to talk about real returns, inflation-adjusted returns. That's what determines your future purchasing power. It's kind of sobering when you look back, right? Even ultra-safe U.S. Treasury bills over a whole century barely beat inflation, like 3.26% return versus 2.90% inflation. Not much real gain there.
Yeah, inflation is the silent thief.
It really is. And here's where it gets even trickier. The actual return you realize in your account isn't just from those fundamentals, the dividends and their growth. There's another piece, the speculative return.
Speculative return, what's that?
It's the change in the dividend multiple. Think of it as how much investors are willing to pay for each dollar of dividends or earnings. It's basically a measure of market sentiment, PE ratios, that kind of thing.
Ah, okay. Market optimism or pessimism.
Exactly. And this speculative part can swing wildly. Over long periods, even decades, changes in sentiment can actually overwhelm the fundamental returns. Bernstein points out that between 1925 and 2021, a massive fourfold increase in this dividend multiple accounted for a fifth of the total real return from stocks. So what you expect from fundamentals can be drastically different from what you actually get because of shifting market moods.
That's wild. It really highlights the role of psychology. Okay, now for something that trips a lot of people up. Do stocks actually get less risky the longer you hold them? It feels intuitive, right? Volatility smooths out over time.
It feels intuitive, but here's where the book throws a bit of cold water on that common belief. Stocks tend to follow what's called a random walk, and counterintuitively, that means the range of possible final outcomes, the dispersion of final dollar values, actually gets wider over longer periods, not narrower.
Wider, not narrower. That seems wrong.
I know it feels backward, but think about it. The longer the time frame, the more opportunity there is for both massive gains and massive losses to compound. The potential for extreme outcomes increases. And academic research backs this up. Zvi did a famous study in '95 showing that put options, basically insurance against market drops, actually get more expensive for longer durations.
If stocks got safer over time, insurance should get cheaper.
Right, exactly. So the market itself seems to agree that risk doesn't just disappear with time. And while lots of studies show stocks outperform bonds over long periods internationally, we need to be careful about survivorship bias.
Survivorship bias, meaning we only look at the markets that didn't collapse.
Precisely. Studies often exclude markets like St. Petersburg in 1917 or Shanghai after 1950 because, well, they ceased to exist for investors.
Yeah.
By only looking at the winners, these studies might paint an overly optimistic picture of future returns. It raises a really important question for you as an investor. What historical data are you relying on? And what hidden biases might be lurking in it?
Good point. And finally, under theory, this concept of Ilmanan risk bad returns in bad times. What's that about?
This is crucial. It's named after Antti Ilmanen. The idea is that some assets, while maybe offering slightly higher returns on average, tend to perform terribly exactly when you need them most during economic crises. Corporate bonds are the classic example. They usually yield a bit more than treasuries. But during market panics like 2008 or early 2020, their prices can plummet due to default fears, right when you might need cash or want to buy cheap stocks.
So they fail you when you need them most.
Exactly. Contrast that with safe treasury securities. Bernstein calls them an elixir of equanimity during crises. Their yields might seem pathetic in good times, but they hold their value or even go up when everything else is crashing. They provide liquidity and stability. That's why someone like Warren Buffett keeps around 20% of Berkshire's assets in T-bills and cash. It's not about yield. It's about having that concentrated courage, that buffer, to stay rational and maybe even take advantage when there's blood in the streets.
Okay, that foundation in theory is critical. Now let's move to pillar 2. Investment history learning from past manias and crashes. This pillar, maybe more than any other, is like your shield against future bubbles. Let's really unpack this core idea. The most powerful force in investing isn't some algorithm or economic policy, it's financial amnesia. We just forget. As a collective, we forget the lessons of the past, which makes us incredibly prone to repeating the same mistakes.
It's almost frighteningly true.
So this dive into history isn't just, academic curiosity. It's your personal defense against getting completely snookered by the next big thing, the next inevitable mania.
Yeah, if you look at capital markets over centuries, they can seem quite orderly. Stocks reliably beating bonds. But zoom in on shorter periods, multi-year stretches, and things can go completely off the rails. Think about the dot-com bubble, or the absolute despair of the early 1930s. Financial amnesia just erases that perspective. Each new bubble feels totally new, totally different, and therefore somehow safe this time. Bernstein mentions knowing how the movie ended during the dot-com boom simply because he'd read about past manias. That foresight, that's what we're trying to help you cultivate.
And these cycles of boom and bust, they're not new at all, are they? Let's go way back, explore some of the earliest bubbles and the birth of leverage, like the 1680s, this diving for dollars craze. Some call it the first tech bubble. It started with a true story, William Phipps finding a massive sunken Spanish treasure.
Incredible story.
Right, and it sparked this frenzy. People started patenting often useless diving engines just so they could form companies and sell shares to the public. Even Daniel Defoe, Mr. Robinson Crusoe, was treasurer for one of these ventures. And despite being on the inside, he still went bankrupt when it all collapsed.
Amazing. And it wasn't just treasure hunting back then. London's goldsmiths, who were becoming bankers, invented fractional reserve banking. This seemingly simple idea created an elastic money supply. Suddenly, banks could lend out more money than they actually held in gold. It introduced systemic leverage, allowing credit to expand and contract not just based on real economic activity, but also on pure human emotion, euphoria, and fear.
So, easy credit plus exciting stories. Sounds familiar.
It's the classic recipe.
Yeah.
This ability to create credit combined with compelling, often overhyped innovations is absolutely central to how bubbles inflate.
Which leads us perfectly to Minsky's financial instability hypothesis. Hyman Minsky, this sort of unconventional economist, had a model for this. He argued bubbles happen when you get elastic credit, usually meaning easy money, falling interest rates combined with the displacement. That's usually some exciting new technology or financial innovation. Think canals, railways, the internet.
Right, the story element.
Yeah.
And Bernstein adds two more critical ingredients to Minsky's mix. First, amnesia of the last bubble. We have to forget the pain of the previous crash. And second, bubbles are often the province of the young. People who haven't lived through a major bust are more likely to dismiss the warnings of older, more cautious folks telling them, you just don't get it this time.
That combination, easy money, a great story, forgetting the past, and youthful overconfidence, it's just incredibly fertile ground for a mania.
A perfect storm, really.
And history just serves up example after example of these iconic manias. Let's talk about the South Sea Bubble in 1720. This was huge. It involved swapping government debt for shares in this company that supposedly had exclusive rights to trade with the Spanish Empire.
Which was a bit dubious itself.
Right. And as the share price went nuts, the government got nervous. But the company actually bribed Parliament, even got the king's mistress involved, and issued fake shares to keep pumping up the market.
The speculation just went completely wild. These bubble companies popped up everywhere, selling shares for ridiculous schemes. Like that famous one for an undertaking of great advantage, but no one to know what it is.
Unbelievable. And Isaac Newton, the genius himself, lost a fortune. He famously said he could calculate the motions of the heavenly bodies, but not the madness of the people. Still true today.
So true. The bubble eventually burst after the government passed the Bubble Act to limit new companies, but huge damage was already done.
Okay, fast forward to the English railway mania in the 1840s. Queen Victoria takes her first train ride, and suddenly railways are this unimaginable public sensation. Bernstein describes it as the jet airliner, personal computer, internet, and fresh brewed espresso all rolled into one. Everyone piled in from chimney sweeps to dukes.
Another tech revolution fueling euphoria, and predictably, a massive bull market followed by a devastating crash. It just shows how human nature, faced with exciting new tech, just doesn't seem to change much. The parallels to the dot-com boom are just uncanny.
Absolutely. And then, of course, the big one, the Roaring Twenties and the crash of 1929.
The defining crash, perhaps.
Yeah, total public obsession with stocks. People crowding brokerage houses, watching the ticker peak. The sheer terror in October 29 when the volume was so high the ticker fell hours behind, people didn't even know how much they'd lost. That Variety headline, "Wall Street lays an egg," just perfectly captured the mood shift.
But in the aftermath of these crashes, sometimes real wisdom emerges. The chaos of the 20s really shook Benjamin Graham, the father of value investing. He was deeply perplexed, wondering how so many smart people got it so wrong. His book, Security Analysis, written right in the depths of the Depression, was his answer. And it led to his frankly startling advice at the time: a simple 50-50 stock-bond split. Even in 1932, when stocks were dirt cheap, yielding 10% dividends, selling below book value, it took guts and rigorous analysis to recommend any stocks then.
His insights were groundbreaking, and the crash also led to reforms, right? The Pecora hearing.
Yes, hugely important. Ferdinand Pecora, this determined lawyer, just systematically exposed the dodgy sales practices of big banks, like National City Bank under Charles Mitchell. That public shaming led directly to the Securities Acts of 1933 and 34, and later the Investment Company Act of 1940. These laws basically made U.S. markets the most transparent and arguably fairest in the world for a long time.
Which Bernstein contrasts with more recent times, like the repeal of Glass-Steagall and maybe less accountability after the 2008 crisis.
A definite contrast, yeah.
And then fast forward again to the incredible irony of that Death of Equities Business Week cover in 1979.
Oh, that's a classic.
Right. The Dow had gone nowhere for years. Inflation was sky high. Everyone was dumping stocks for gold, diamonds, real estate. The article just perfectly captured the mood. Stocks are dead.
But the beautiful irony, as Big points out, was that the older investors, the ones who remembered how to value stocks, who understood market cycles, they were the only ones sticking with equities. They knew from history that brutal bear markets are often the prelude to powerful bull markets. It just makes you wonder, listener, what narratives, what headlines today are you internalizing, and how might they be subtly skewing your long-term view?
That historical lens is so crucial for understanding something much scarier than a temporary dip. Deep risk, the permanent loss of capital.
Yeah, this is different from shallow risk, which is just the normal, albeit painful, up and down of markets. Deep risk is a permanent loss of real inflation-adjusted capital. A loss so bad it genuinely jeopardizes your ability to fund your life, especially retirement. Think about holding U.S. bonds from 1941 to 1980. Over those 4 decades of high inflation, their real value shriveled to just 34 cents on the dollar. That's deep risk.
Wow. So what causes it? Bernstein talks about the 4 horsemen of deep risk.
Right. In decreasing order of likelihood, number one, and the most common, is inflation. Like those bonds, it just silently eats away your purchasing power.
Well,
Interestingly, even during the crazy Weimar hyperinflation, equities generally still provided positive real returns, though with insane volatility, inflation hits bonds hardest.
okay, inflation first. What's next?
Second is confiscation. Outright seizure by the government. Like Argentina grabbing private retirement funds in 2008. It happens.
Scary thought. Third.
Third is devastation. War, revolution. Things that just destroy economies and markets. Think Europe after WWII, or Russia and China where markets literally closed for decades.
And the last one.
Fourth, and probably least likely today with active central banks, is deflation. A sustained fall in prices. Historically significant, but less of a primary worry now, perhaps. Understanding these deep risks forces you to think beyond normal market volatility, to consider true portfolio resilience.
Okay, pillar 3. This one hits close to home for everyone. Investment psychology, the enemy in the mirror. So what does all this theory and history mean for you? Well, Benjamin Graham nailed it. An investor's biggest problem, usually themselves.
It's so true. And modern neuroscience gives us the why. We have this ancient, fast, emotional System 1 brain, the limbic reptilian part, versus our slower, logical, conscious System 2 neocortex. And System 1, well, it's often our worst financial enemy.
Because it's wired for immediate survival, right? Not long-term investing.
Exactly. Our evolution favored avoiding short-term threats, finding the next meal. Mother Nature did not design us to calmly handle the abstract long-term risks of the stock market. This mismatch makes us prone to panic at exactly the wrong times.
And System 1 messes with our ability to predict. It also highlights the surprising limits of expertise.
Yeah, Philip Tetlock's research is fascinating here. He found that expert predictions in fields like politics and economics were consistently worse than simple statistical rules or base rates. Experts just weren't as good at forecasting as everyone assumed. A humbling finding.
Makes you skeptical of forecasts.
Definitely should. And this poor prediction is amplified by what Kahneman and Tversky called heuristics, those mental shortcuts we use to make quick decisions in a complex world. They're often useful, but they lead to predictable mistakes, like the Steve the Librarian example. Give people a description of a shy, detail-oriented guy, and they ignore the fact that there are way more farmers than librarians. The stereotype overrides the base rate statistics in our heads.
Which underlines the power of narratives versus data. We humans seem dangerously drawn to good stories.
Kurt Vonnegut said it best, "Man have to say he understand." When things get complex or uncertain, we default to storytelling. It creates this comforting illusion of understanding, even when we're actually clueless. It feels good, but it's a trap for investors.
And this creates a huge conflict for opinion sellers, right? The brokers, the TV pundits.
Absolutely. Their job is to craft compelling narratives to persuade you, often to buy something. But you, the opinion consumer, need to rigorously ignore those stories and focus purely on data, facts, analysis. As Bernstein says, if it's big news, it's already baked into the price. The story won't give you an edge.
Okay, let's talk specifics. What are some of the most common psychological traps we fall into? First, the lottery ticket syndrome.
Ah, yes. What's fascinating here is how people are just drawn to glamorous long-shot investments like tech IPOs or meme stocks, even though tons of research shows these consistently underperform over time.
Why do we do it?
It's just more fun, isn't it? More exciting to chase the next potential 10-bagger than own a boring, profitable company. Even things like art collecting, often more about aesthetic pleasure than real financial return, but we tell ourselves it's an investment.
Guilty as charged sometimes. Okay, next trap. Risk aversion myopia.
This is our ancient brain freaking out over normal market ups and downs. We get fixated on short-term losses, the immediate pain, and completely ignore the much bigger long-term risk. Not having enough money down the road. Studies show that during downturns, most investors' time horizons shrink dramatically, maybe to just a year or so. This intense short-term focus leads to really painful psychological experiences and often terrible decisions like selling at the bottom.
Then there's the representativeness heuristic leading to a couple of classic mistakes.
Right. First, the good company, good stock fallacy. We assume exciting, fast-growing companies must be great stocks. But often, it's the boring, unloved value companies that do better. Why? Because they have to offer higher expected returns to attract investors. Their unpopularity is paradoxically their strength.
And the second fallacy.
Believing that rapid economic growth must equal a great stock market. Sounds logical, but again, history disagrees. Look at China. Incredible economic growth from 93 to 2022, but its stock market significantly lagged that growth. Our intuition, based on these simple representations, often fails us in finance.
We also suffer from WISIAD.
Yeah.
What you see is all there is, and recency bias.
Yeah, our tendency to overweight recent, vivid events. Remember the super low treasury yields in 2020? Everyone assumed rates could only go up. Then came the brutal bond market rout in 2022. We extrapolate the recent past, often incorrectly. Bernstein calls this the engineer's mistake, focusing only on the numbers, the math, and ignoring the Shakespeare, the human drama, and emotion of investing. Ironically, this was a key failure at LTCM, brilliant engineers, ignoring the human element.
And maybe the biggest trap, overconfidence. Looking in the mirror and thinking we're better than we are.
Oh, definitely. Yeah. We consistently overestimate our driving skills, our social skills, our looks, and especially our investing ability and our tolerance for risk. The book really stresses this. Experiencing real-world losses is viscerally terrifying. It's not like a spreadsheet. It comes with deep fears, systemic collapse, hyperinflation, whatever the bogeyman of the day is.
Yeah.
That emotional turmoil makes clear thinking incredibly hard.
And the final trap, envy. Watching your neighbor get rich quick.
Relative wealth. That old joke about envy being the only sin that isn't any fun. In investing, it means envying someone else's hot stock or fancy hedge fund, which tempts you to abandon your own sensible plan. The book uses the Yale endowment model as an example. It worked great for Yale, got copied by everyone, became a crowded trade, and then average university endowment started underperforming a simple 60-40 portfolio. Chasing what others have can be really destructive.
Okay, so we're biased, emotional creatures. How do we fight back? What are the strategies for good behavior?
Well, connecting back to value investing, the highest expected returns often come when an asset class is deeply unpopular, an object of popular revulsion. Think junk bonds after a crash, or REITs when everyone hates real estate. When something is cheap and unloved, its potential future returns are likely higher.
So buy what's hated takes courage.
It does. And treat eloquent narratives as alarm bells. Remind yourself constantly, you are the storytelling ape, but as an investor, you must avoid narratives at all costs. The more compelling the story, the more extreme the prediction, the more likely it's a reliable marker for poor forecasting. Be skeptical of smooth talkers.
And ignore market patterns, just assume they don't exist.
Pretty much. Except that patterns in the stock market are likely a chimera, a mirage created by randomness. The safest assumption is no reliable patterns exist. So ignore market strategists trying to sell you on them. If they could really predict things, they wouldn't be selling advice.
Makes sense. Emotional discipline is key then, that concentrated courage.
Absolutely. That gut reaction to losses, System 1 screaming sell, that's nature trying to make you poor in the long run. You have to learn to see bear markets as opportunities, reminding yourself low prices mean higher future returns. Safe assets, like T-bills, are your concentrated courage. They give you the stability to stay rational. And a warning for the wealthy. Don't be a whale. Yeah, basically be wary of those exclusive hedge funds and private equity deals. Bernstein argues they're often designed primarily to extract high fees and commissions from wealthy investors. A simple, diversified portfolio of low-cost index funds is highly likely to outperform your neighbors in the fancy funds over time. Simplicity often wins.
And finally, humility.
Crucial. Just accept that the market is much smarter than I will ever be. Your best bet isn't to try and outsmart it, but to join it as inexpensively and efficiently as possible through broad diversification and low costs. Acknowledge the market's collective wisdom.
Which leads us neatly into Pillar 4, the business of investing navigating the financial landscape. The good news is the retail investing world has improved somewhat thanks to technology and lower fees. But, as Bernstein warns, you still need to be really careful. Treat it like a battlefield where your interests often aren't the priority.
He calls them the carnies barkers, which paints a picture. Historically, you had brokers churning accounts, making trades just to generate commissions, which was directly against the client's interest. That shifted somewhat towards fee-based investment advisors, which sounds better. But even the current standard Reg BI, or Regulation Best Interest, is pretty weak. It's often not a true fiduciary duty, which would legally require them to act solely in your best interest. Big difference.
Didn't Charles Merrill try to fix this way back?
He did. Merrill Lynch initially paid brokers salaries, trying to build trust by removing the commission incentive. And it worked. For a while, people flocked to them for unbiased advice. But after Merrill died, the old commission culture eventually crept back in.
So today's advisors often justify their fees how?
By selling complexity. Often. Showing you portfolios with tons of individual stocks, lots of different funds that probably overlap anyway. It looks sophisticated, justifying that 1–2% annual fee, but often simple and cheap is better.
And an even bigger warning about the insurance company swamp.
Oh yeah. The core message here. Insurance is for protection, not investment. Use term life for life insurance, get disability insurance. But avoid complex, high-fee products sold as investments.
Like what specifically?
Things like variable universal life, whole life, universal life, and those fixed indexed annuities. Annuities, for example, often cap your potential gains to give you some downside protection. But that cap usually means much lower long-term returns than just being in the market, plus you still have inflation risk eroding the value of those future payments.
And they sell these how? Through fear.
Often, yes. Using those narratives engineered to stimulate our reptilian brains. Appealing to fears like leaving your family destitute or the lure of avoiding taxes. These emotional pitches are designed to distract you from the high fees, the complexity, and the generally poor investment value of the products.
Okay, so lots of pitfalls, but there was a revolution,
Right.
right? The Bogle revolution, the rise of indexing.
Absolutely. John C. Bogle, just a giant in the field. He fought his way back after being pushed out of Wellington Management, founded Vanguard in 1974. He was hugely influenced by Paul Samuelson's 1974 paper suggesting a simple S&P 500 index fund would beat most active managers.
And it wasn't popular at first. Bogle's folly.
Not at all. It raised hardly any money initially. But what's fascinating is that its eventual success was almost mathematically inevitable. William Sharpe's arithmetic of active management proved that active managers as a group must underperform the market after costs. So the index fund's low-cost advantage just wins out over time as manager skill, or rather, luck, tends to wash out. Like Jonathan Clements said, performance comes and goes, but expenses are forever.
Such a simple, powerful idea.
And it led to this explosive growth. Index fund assets now rival or exceed active funds. Even firms like Fidelity, who mocked Bogle early on, now offer index funds, sometimes even with zero fees. Though Bernstein does raise some valid concerns about indexing now, mainly the huge concentration of market ownership in the big three index providers, BlackRock, Vanguard, and State Street. They own a massive chunk of the U.S. market, raising questions about corporate governance and influence.
And then came ETFs, the next evolution, but with their own dangers.
All right, exchange-traded funds,
Wow.
they have advantages. You can trade them all day like stocks, no minimum investments usually, and they have this externalization of trading costs. Basically, the frequent traders pay for their own trading, not the long-term buy and hold investors in the fund. That's fair.
But there's a dark side.
Definitely. The book warns strongly about toxic leveraged and inverse ETFs. These try to deliver, say, double or triple the daily return of an index, or the inverse, like ProShares Ultra Real Estate or Ultra Short Real Estate.
Why are they toxic?
Because of that variance drag, again, amplified. Trying to multiply daily returns leads to horrible compounding effects over time. These things can lose enormous amounts of money, even if the underlying index goes up, due to the map of daily resets. Their excuse is they're only for short-term holdings, but Bernstein rightly says that defies both logic and simple arithmetic. If it's a terrible long-term investment, it's almost certainly a terrible short-term one, too. Avoid them.
Got it. And finally, the financial media, Bernstein calls it.
Financial pornography,
Oh.
a stark term. But his point is that so much investment coverage perpetuates the myths and false promises of stock picking, market timing, and asset allocation fairies. It's often predators and prey, and the media frequently takes the predator's side.
And social media has made it worse. GameStop.
Oh, absolutely. Amplified the frenzy. Jean Brian Quinn's critique about perpetuating myths is spot on. And think about CNBC's role. Roger Ailes deliberately turned finance into a spectator sport, prioritizing ratings and entertainment over solid information. Think flashy personalities, rapid-fire calls.
Like Mad Money.
Exactly. Studies actually show stocks mentioned on shows like Mad Money get a temporary price bump, then fall back. It suggests viewers are often the last ones in, getting played by those acting earlier.
So if we want useful info, what should we read, watch, listen to?
Avoid most of it, honestly, especially cable TV, finance, social media echo chambers, maybe even the daily newspaper business section. Exceptions for high-quality analysis would be things like The Economist or the Financial Times. Online, reliable places include bogleheads.org, humbledollar.com, Investopedia, and of course, good books on financial history, psychology, and practical guides are invaluable. Filter ruthlessly.
Okay, we've covered a ton of ground: theory, history, psychology, the business itself. Now let's try to put it all together. Building your winning portfolio. The absolute most critical decision, what Bernstein calls your whole Torah, your guiding light, is figuring out your personal, appropriate split between stocks and bonds. Your asset allocation, that's the core.
Everything else flows from that. And a surprisingly good starting point for many is the simple couch potato portfolio. Just a 50-50 mix of stocks and bonds. Easy to manage, reasonably effective for a lot of people.
But it's not one size fits all, right? Life cycle investing matters hugely.
Massively. Your allocation should change as you age. Think about a young investor, Bernstein's example, Frida. She has decades of earning potential ahead her human capital. That future income stream acts kind of like a stable bond in her overall wealth picture.
So she can afford more stock risk.
Theoretically, yes, maybe even close to 100% stocks early on. But theory meets reality here. Real-world risk tolerance is key. So Bernstein suggests starting low and slow, maybe 60% equities to see how you feel during a downturn, then maybe gradually increase it if you can handle the volatility emotionally.
Makes sense. What about retirees? The goal changes completely.
Completely. It shifts from growing wealth to preserving it and ensuring you don't run out of money. You need to defease liabilities, lock down enough income to cover your expenses. For someone with a high burn rate, say, spending 4% or more of their portfolio each year, protection is critical. That means things like deferring Social Security until age 70. It's a great inflation-adjusted annuity. Maybe building a ladder of TIPIs, inflation-protected bonds. Their stock allocation might only be 40-50%.
But what if you're fortunate, low burn rate?
If you're lucky enough to only need, say, 1% of your portfolio annually, like Frank in the book, you can actually afford more stock risk, even in retirement. You might even use a reverse glide slope, gradually increasing your equity percentage after retiring to capture long-term growth since you have a huge safety margin. Frank might be comfortable with 70–80% in equities. It all depends on your specific situation and needs.
Okay, so once you have your stock bond split, how do you build the portfolio's core?
Global diversification is key. Aim for a total world stock market exposure. The current global market cap is roughly 61% U.S., 39% foreign. That's a good starting point. U.S. investors might reasonably tweak that foreign exposure down a bit, maybe to 30–50%, because their expenses, like mortgages, are in dollars, and there can be tax reasons in retirement accounts. But the main idea is, don't bet heavily on just one country.
What about tilting towards small cap value?
That's a more advanced strategy, basically a bet on risk premiums. History shows small and value stocks have outperformed over the very long term, though they can underperform for long stretches, like recently. Right now, value stocks look historically cheap relative to growth stocks, which might suggest higher future returns. But you absolutely need the patience and tolerance to stick with it when it's lagging the main market. An aggressive younger person might put, say, 2/3 in a total market fund and 1/3 in small value, but it requires conviction.
Any other ancillary asset classes? REITs, gold.
Bernstein suggests maybe small slices like 10% max combined for things like REITs for diversification and dividends, or precious metals resource stocks as an inflation chaos hedge. But he adds strong warnings. These are complex, volatile, and often perform strangely. They're more like portfolio insurance for specific risks, not core return generators, probably only for the asset class junkies who really understand them.
Okay, so that's stocks. What about the bond allocation, the lifeboat?
Exactly. Think lifeboat or sleeping draft. Bonds are there for safety, stability, to keep you calm during storms, especially during that Ilmanen risk when stocks and risky bonds might crash together. The advice is crystal clear. Prioritize safety. Stick to short-term treasuries, maybe high-quality CDs, potentially high-grade municipal bonds if you're in a high tax bracket. Crucially, avoid most corporate bonds. Their yields aren't usually high enough to compensate for the risk that they'll lose value precisely when treasuries are holding firm in a crisis.
Maybe a ladder of individual treasuries.
Yeah, a 3 to 5 year ladder of individual treasuries or CDs is a solid approach. It gives you predictable income and staggered maturities, reducing interest rate risk somewhat. Keep the bond side simple and safe.
Got it. Now, how do we maintain and spend this thing? Rebalancing.
Rebalancing is crucial for 2 reasons. First, it controls risk. It keeps your allocation from drifting too far towards stocks after a bull run, making potential losses more manageable. Second, and maybe more importantly, it's psychological conditioning. It forces you to sell high, trimming winners, and buy low, adding to losers, which is the opposite of what your emotions scream at you to do. Doing it mechanically, say every 2 to 5 years, helps enforce discipline, ideally in tax-sheltered accounts to avoid realizing gains.
Should you ever make strategic adjustments or just stay the course, like Bogle said?
Bogle was strict, stay the course. Bernstein suggests modest, infrequent strategic tweaks might be okay if valuations get truly extreme, like maybe slightly trimming the S&P 500 if it looks insanely bubbly, or adding to emerging markets after a brutal crash. But these should be rare, small adjustments, not market timing.
And spending in retirement, how do you draw down?
He suggests a kind of value averaging in reverse. When stocks are doing great, sell some equities to meet your spending needs and bring your allocation back in line. When stocks are in a bear market, spend from your bonds first, giving the stocks time to potentially recover without forcing you to sell them low.
Makes sense. But underpinning all of this, the saving imperative.
Absolutely fundamental. Bernstein hammers this home. If you can't save, it doesn't matter how well you invest. Remember The Millionaire Next Door? It showed how frugality, living below your means, avoiding that hedonic treadmill of constantly needing more stuff, that's often the real key to wealth. Frugal plumbers often retire richer than high-spending lawyers because they prioritize saving. It really forces you to ask, what is money really for? Buying more stuff, or buying freedom, time, autonomy, fuck you money as it's sometimes called. That shift in perspective is powerful. It truly is. Puts the whole endeavor in context.
And that really brings us to the end of this deep dive. What's so fascinating and what we hope you really take away is how all 4 of these pillars just intertwine and support each other. You've got investment theory giving you the risk-return reality check, investment history acting as your defense against amnesia, against repeating bubble mistakes, investment psychology helping you battle the enemy in the mirror, those System 1 biases, and then understanding the business of investing helps you navigate the industry minefield, avoiding the pitfalls and high fees. You neglect any one of those pillars, and yeah, your investment chair gets really unstable, likely to tip over eventually.
It's definitely not a one-and-done thing, is it? Investing is this ongoing journey, continuous learning, adapting, but mostly discipline. The landscape changes, tech evolves, but these core principles we've talked about, they're pretty timeless. They're your essential toolkit for riding out the market's inevitable storms and building real, lasting wealth.
So, as a final thought, something provocative, maybe, for you to chew on for your own journey. Remember this powerful line from the book. You will experience such moments of market meltdown at least a few times in your investment career, and nothing will see you through them as well as your T-bills and CDs, no matter how low their yield.
That really sums it up.
Yeah, it underscores that true success isn't always about chasing the absolute highest number. It's about building the resilience, the psychological strength, that concentrated courage to simply stay the course when things get truly scary. It's about securing your future, your autonomy, not just maximizing this year's return.
Couldn't agree more. Protecting future you from present you, in a way.
Exactly. Well, that's all for this deep dive. We genuinely hope this exploration has given you some clear, actionable ideas for your own portfolio, and maybe more importantly, the mental framework to stick with your plan. Until next time, keep digging deeper.